The biggest threat to your investment portfolio isn't the market, it's your own mind. Investors lose millions every single year because of psychological mistakes they don't even realize they're making. Today, I'm going to break down the 5 biggest behavioral finance errors investors make and, more importantly, how to avoid them. By the end of this video, you'll know exactly how to spot these mistakes before they cost you tons of money. Behavioral finance error number 1 is loss aversion, or the fear of losing money. And what that really means is that investors fear losses more than they actually enjoy gains, enjoy those victories, enjoy those wins. A good example would be that a 10% loss feels twice as painful as a 10% gain feels rewarding. And that's according to Nobel Prize winning research by Daniel Kahneman, who's one of the brightest minds as it relates to behavioral finance and behavioral economics. Now, here's why this is a problem. What this does is it causes investors to panic sell during downturns and pullbacks and bear markets and corrections instead of buying at discounts. They make the wrong move at the wrong time. And here's how we want to fix it. We need to reframe those losses as opportunities. We need to view it as if we are buying good quality assets, good quality companies while they are on sale. That's what Warren Buffett would do, right? We also need to make sure we set an investment plan and stick to it no matter what the market noise is telling us, no matter what's going on. You can kind of tune out the headlines, set your investment plan, and stick to it. And I'll tell you, the best investors, they don't panic. They see downturns as a chance to buy great assets on sale at a great price. Behavioral finance error number 2 is what we call recency bias. That's believing that the past equals the future. It's very common that a lot of investors have short-term memory. Again, that's another component of recency bias. So investors always assume that recent market trends, what happened over the last 3 months, 6 months, 12 months, are going to continue forever into the future while forgetting about longer-term historical trends. In 1999, investors believed the tech stocks would never crash. In 2008, they thought real estate will always go up, and they were proven wrong in both of those scenarios. What this does is it leads to buying at market tops and selling at market bottoms, and nobody makes money buying high and selling low. And people do that despite the fact that longer-term historical data might tell them to do otherwise. Now, here's how we fix this. We need to use historical data. And I'm not talking about the last 3 months. I'm not talking about the last 3 years. I'm talking about the last 10, 20, 30 years. We need to use longer-term historical data because markets, they move in cycles, not straight lines. The other thing we need to do is we need to diversify our investments so that we can protect against these bubbles when they eventually burst, against these collapses, against these bear markets. Diversification is key. And I'll tell you, what's hot today might not be hot tomorrow. So we need to ensure that we are investing in cycles, not chasing hype. Behavioral finance error number 3 is overconfidence bias. And basically, that's just thinking that you're smarter than the market. And a lot of us do that. You know, what really happens here is that a lot of investors overestimate their ability to beat the market, to pick the best stocks, all that stuff. And, you know, according to the CFA Institute, 85% of retail traders believe that they will outperform professionals. Now, here's why that's a problem. What that does is it leads to excessive risk-taking, stock-picking mistakes, and ignoring fundamentals. Now, the way we fix that is we need to focus on long-term wealth building, not short-term bets. We need to find companies that have sustainable growth stories, something that's going to last 3, 5, 10 plus years and beyond. We also need to use a diversified portfolio instead of trying to time the market. Typically, what we're doing for our clients is we're investing in at least 50 or so stocks, and then we're investing across all the different sectors. We are not putting all 50 stocks in the tech sector. We're going to own some healthcare. We're going to own some consumer staples. We're going to own some tech. We're going to have exposure to it all. We want to make sure we remain diversified. The best investors, typically don't try to outsmart the market. They focus on consistent long-term returns. Behavioral finance error number 4, confirmation bias. And I'll tell you, that's really only seeking what you want to hear, which is not a good recipe for success. It's when investors only listen to news and opinions and analyst updates that confirm the beliefs they already have. And, it's very typical that you see bullish investors ignore warning signs while bearish investors miss opportunities. Let's assume you're a big fan of Nvidia or Apple or Palantir and you own a lot of it and you really are bullish on those stocks and you believe they're going to go up. When an analyst report comes out with a downgrade, chances are you might not give as much credence to that downgrade as you might to some analyst the next day who might upgrade it, raise the price target, and cause you to be more bullish than ever. And here's why this is a problem. What it does is it creates blind spots and prevents rational, well-rounded decisions based on empirical data, based on statistics, based on numbers. And the way we fix this is, number 1, always challenge your own opinions. You always have to see if you might have a blind spot. Is there a different case out there? You might be a bull, but you want to hear the bear case as well. So you need to listen to both bullish and bearish perspectives before you make any decisions at all. Smart investors, they don't seek agreement, they seek the truth. That's what we aim for. And behavioral finance error number 5, the herd mentality, following the crowd, also known as FOMO, fear of missing out sometime. So what this is investors copy what everybody else is doing, especially in market manias. I mean, you look back to right after the pandemic, maybe early 2021, Bitcoin, meme stocks. You remember AMC, GameStop, companies that were essentially obsolete. All of a sudden, a bunch of those Reddit traders got behind them, pumped them up. It got to the point where a lot of investors had to own some. They wanted to own some because they had FOMO, fear of missing out. Here's why this is a problem. By the time everybody else is piling into something, it's probably too late. Everybody already knows about it. You're getting in too late. The way we fix this is you need to look at fundamentals, not social media hype. Ignore the Reddit message boards. They're all trying to drive prices up. They are not basing most of their trades on fundamentals or technicals or charts, whatever it might be. You have to have some sort of a way of examining investments for what they actually are. And you want to make sure you're following the smart money, not retail speculation. And I'll tell you, if the masses are rushing into something, chances are you're already too late. All right, so here's how you become a more rational investor. Step 1, build a systematic investment plan and stick to it. Stay disciplined. If you decide that you are going to buy ABC stock at $100 a share and it drops down to $95, buy it. You already made that decision. You made that decision when emotions weren't a factor. You made that decision logically. So come up with a logical, systematic investment plan, stick to it, and stay disciplined. Step 2, use data, not emotion, to make decisions. And that might be fundamental analysis, looking at the quality of a company's management team, their growth story. Is it interesting? Is it sustainable? Does it have the ability to outpace the growth of the broader market over the course of the next 3, 5, 10 years? You might want to look at charts. You might want to look at technical analysis and some ratios to determine which positions you want to be in. So use hard data, not emotions. In step 3, think long term. Ignore the short-term noise. There's so much short-term noise out there that drives the markets from day to day, from week to week. And if you can just kind of put your blinders on, put your nose down, and focus on the data, you can make smart decisions for yourself. If you want to learn how to invest smarter and avoid these common mistakes, hit that subscribe button, like this video, hit the notification bell, and tell me in the comments. I want to hear, which behavioral bias do you think is the most dangerous?